us now for more is Melissa Lopez, the Chief Economist for ASEAN at Lundgreen's Capital, which has just won the prestigious Lipper Award for one of its investment funds. So good to see you, Mel, and congratulations for the award.
Thank you, Cathy, and thanks for having us. It's really a great recognition for what we do. The Lipper Award is kind of like the Oscars of the finance sector.
It is, and in fact, it is the best 5-year track record among China's stock funds. So the question really is, how do you sustain it with what's going on with the Trump tariffs, the uncertainties, and the realignments going on?
Right. Actually, I think the difference in what we do is we're really upbeat about the Chinese and the Southeast Asian markets, mainly because we believe and we see that there are really internal sources of growth that they can cultivate further at a time when everyone else in the developed world is slowing down. In China, there's room to boost domestic consumption, private sector growth, and really that's what we're seeing. And we focus on those high growth sectors and companies.
Yeah, but we got to also focus on the fact that China's just released its manufacturing figures, and that's a slowdown to its slowest in 16 months.
Yes.
So shouldn't that be a cause for concern?
Yes, we do recognize that, but we focus on about 45 hand-picked companies that we've really seen, studied the books, the assets from sometimes even before they list in stock exchanges outside China. So we know the trajectory of these companies. Of course, right now we're not as bullish with the manufacturing companies. More towards high-tech sectors is what we're investing in.
High-tech, but even that is going to be hit by the tariffs. So how do you work that out?
We look at countries or companies that look to other alternative markets. So we've seen China open up very recently a new trade route to Peru. So they're looking towards Latin America, and that is also a promising consumer market. We know that the US is 25% of world GDP, but you have the 75% that you can look to now that there's a tariff war.
And that's part of us. We're part of that 75%, the Philippines. You can only imagine that the alphabet would be working in our favor. There's Peru, but there's also the Philippines. So how much of a chance do we have that extra manufacturing would move to the Philippines if it hasn't yet?
Yes, I know that it will take time. So it really boils down to what we can offer, and especially the ease of doing business, lack of infrastructure. The sooner that we can address these gaps, the more that we become more attractive to these relocating companies or setting up new or duplicate factories just so they could skirt the very high tariffs of the US.
And we also have to look at our neighbors because they're also competitive even before the tariffs came to be. All the manufacturers were going to the Vietnams, the Thailands, and ASEAN.
If anything, we are not the worst off in the set of tariffs from the Trump administration. Definitely 17% is better than the 46% in Vietnam. So we'd have to make it more attractive for these relocating companies to come to us. So that's incentives, that's fixing our infrastructure gaps, maybe lowering the cost of power and the cost of doing business in general.
And I'm thinking now about how difficult the job it is for Go and Chris Aldeguer to actually make a difference in the negotiations happening with the U.S. Trade Representative. So what would be the best outcome, given that there are relative differences in 17%? I mean, Vietnam might be able to, pull that down to zero, and we're off the charts. I mean, we're off the list if that were the case.
Of course, anything closer to 0% would be beneficial for us. It would be growth positive. What I'm seeing right now is, and what's really not clear at the moment is what would the U.S. ask from us in return? And I'm thinking it's going to be more towards the geopolitical side more than financials, because we do have a narrow trade surplus with the U.S., but we're not as big of a manufacturing hub as Vietnam with their garments, or of course with China, with basically everything else. So I believe that would be the direction of the discussions, but it's a matter of what are we willing to provide as well in return.
So it could be a leverage, our defense treaty partners' status, and the F-16 jets that we're buying, and all the other military equipment that we're going to need that's going to make a big dent on the trade figures. So where does that take us then with the Bangko Sentral? They've already guided towards a lower range in the inflation forecast. How many more rate cuts are you seeing down the line? if Fed Chief Powell does not move,
Yes.
despite the pressure from Trump?
Of course, the independence is very important. I see the Bangko Sentral cutting rates at least or at most one more time this year. Definitely not in June. Similar to the Fed, cautiousness will prevail. And we know that the BSP really kind of matches what the Fed does. And from the April cut, they've already matched the 100 basis point cumulative cut that the Fed has done last year. So now that inflation is easing, that of course bodes well, but also you need to be more careful. Of course, the tariff situation could be quick in terms of pushing prices up. We've seen the US contract in Q1 when it doesn't even cover the Liberation Day tariffs yet in April. So it's best to pause, maybe a 25 basis point cut, one more around the third quarter is what we're seeing.
30 seconds, 55 to the dollar. Is that cause for concern for the OFWs remitting home?
Oh no. We know that we look at currency at the long game, and it is a fluctuation, but it will correct down the road.
Got that. Well, thank you so much, and for joining us on Labor Day holiday. Appreciate it.
Thank you.
Lopez of Lundgreen's Capital. And you're watching Money Talks. Coming right up, the Philippines trade deficit